In the mid-1970s, Peter Lynch's wife came home from the mall raving about a new store called Legs, a pantyhose brand that had figured out how to sell hosiery in supermarkets instead of department stores. Lynch went to investigate. He liked what he saw. He bought the stock. It became one of his earliest 10 baggers, a stock that returned 10 times his investment. That story is not unusual for Lynch. During his 13 years running the Magellan Fund at Fidelity, from 1977 to 1990, he averaged 29.2% annual returns, the best long-term record of any mutual fund manager in history. A $10,000 investment in Magellan in 1977 was worth over $280,000 when he retired, and his entire system was built on one radical idea: ordinary people, shoppers, employees, consumers, have access to investment information that Wall Street analysts will never have. In this video, I'm going to walk you through the 6 signals Lynch used to find stocks that returned 10, 20, 50 times his investment, before the professional money ever noticed them. Signal 4 is the one that separates Lynch from every other investor we've covered in this series, and it's available to anyone with a shopping cart. Stay with me. Peter Lynch is different from every investor we've covered in this series. Buffett looks for businesses with durable competitive advantages and holds them for decades. Munger builds mental models to think more clearly about complex problems. Dalio designs systems to survive every economic environment. Lynch did something simpler, and in some ways more powerful. He paid attention to what was happening around him, in stores, in restaurants, at work, in conversations with family, and he followed those observations into the stock market before Wall Street did. He called it invest in what you know, but that phrase, stripped of its context, is often misunderstood. Lynch didn't mean only buy familiar brand names. He meant use your professional expertise, your consumer experience, and your daily observations as a first screen, a way to identify businesses worth investigating further before the analysts discover them. At its peak, the Magellan Fund held over 1,400 individual stocks. Lynch tracked them all. He visited companies. He spoke to management. He read annual reports obsessively. His edge wasn't a computer algorithm or proprietary data. It was shoe-leather research combined with the kind of consumer insight that no institutional investor sitting in a Manhattan office tower could easily replicate. He identified 6 signals that, when present together, pointed toward a potential 10-bagger, a stock that could return 10 times the investment. Signal 1 tells you where to look first. Signal 4 is the one most institutional investors are structurally prevented from finding. And Signal 6 is the sell signal, the moment Lynch knew a 10-bagger had become a value trap. Let's get into it. The signal. Lynch believed that the best stocks often came wrapped in the most unappealing packaging. A company called Automatic Data Processing. Boring. A waste management company, unpleasant. A funeral home chain, morbid. A ball-bearing manufacturer, incomprehensible to most investors. Lynch loved these, not because boring is inherently good, but because boring drives away competition. When a business sounds dull, institutional investors don't cover it, analysts don't write reports on it, and financial media doesn't feature it. The stock gets overlooked. And overlooked stocks can be underpriced. How Lynch used it. One of his most famous investments was a company called Pep Boys, an auto parts retailer. Not glamorous, not exciting, but the business had consistent demand, low competition from institutional investors, and growing unit economics. Lynch held it through a 25-fold return. He contrasted this with the behavior most investors exhibit: chasing exciting companies in exciting industries, technology stocks, biotech, anything that sounds like the future. These businesses get covered obsessively, which means they're also priced obsessively. The boring company in a dull industry gets left alone, which is exactly the opportunity. How you apply it. When you next look at your investment watch list, notice which businesses make you feel nothing. The industrial supplier, the waste processor, the generic drug manufacturer. Those are the ones worth a second look. If the business is genuinely good and the stock is genuinely cheap, the boredom premium you get for holding it is real. Signal 2 is related, but more specific. It's about a particular kind of company that Lynch called the perfect candidate for a 10-bagger. The signal. One level beyond boring, Lynch identified businesses that people actively avoided thinking about. Debt collection agencies, toxic waste cleanup, casket manufacturers, pest control companies. These businesses share a common trait: steady, recession-resistant demand combined with near-zero investor interest. Nobody wants to talk about them at dinner parties. Nobody pitches them at investment conferences, which means nobody is bidding up their valuations. How Lynch used it. Service Corporation International, the largest funeral home chain in North America, was a Lynch favorite. The business was morbid by definition, but it had predictable demand. Death is not cyclical. Pricing power, bereaved families rarely comparison shop, and a consolidation opportunity as it acquired independent funeral homes across the country. Lynch bought it when it was small, obscure, and deeply unsexy. He held it through a multi-bagger return while the rest of Wall Street was chasing technology companies. How you apply it. Look for businesses that provide essential services in industries people prefer not to think about. Ask, is the demand recession resistant? Is there pricing power? Is institutional coverage low? If 3 answers are yes, start reading the annual report. Signal 3 is about a specific financial characteristic Lynch looked for, one number that told him whether a stock was genuinely cheap or just cheap-looking. The signal. Lynch popularized the P/G ratio, price to earnings divided by the earnings growth rate. A P/E ratio alone tells you how expensive a stock is relative to its current earnings. But it doesn't tell you whether that price is justified by how fast the business is growing. A stock at 20 times earnings growing at 25% per year is cheaper in real terms than a stock at 12 times earnings growing at 5% per year. Lynch's rule. A P/G ratio below 1.0 is potentially attractive. A P/G ratio above 2.0 means you're paying significantly more than the growth justifies. How Lynch used it. Lynch used the P/G ratio as a rapid filter, not as the final decision but as a first screen. If a company passed the boring test, the disagreeable test, and had a P/G below 1.0, it earned a deeper look. He was clear that P/G works best for stalwart companies and fast growers. For cyclical businesses, asset plays, and turnarounds, different valuation frameworks apply. The P/G is not a universal tool. It is a useful one in the right context. How you apply it. For any stock on your watch list, divide the P/E ratio by the expected annual earnings growth rate. If the result is below 1.0, investigate further. If it's above 2.0, make sure you have a compelling reason to pay that premium. Most of the time, you won't. Signal 4 is the one I mentioned at the start, the signal that institutional investors are structurally prevented from finding. And it's the reason Lynch believed individual investors have a genuine edge over Wall Street. The signal, why this is peak. Lynch called this the institutional neglect signal, and he considered it one of the most powerful indicators of an underpriced stock. When large institutional investors, pension funds, mutual funds, insurance companies, own a significant portion of a company, 2 things happen. First, the stock is already widely analyzed, which means information about it is efficiently priced in. Second, any positive surprise is already anticipated. The easy money has been made. When institutions own very little of a company, or none at all, the opposite is true. The stock is less efficiently priced. A positive earnings surprise can cause a disproportionate move because nobody was positioned for it. Why institutions can't find these stocks. Here is the structural insight most investors miss. Large institutional funds cannot own small companies in meaningful size. A fund managing $50 billion cannot put 1% of its capital, $500 million, into a company with a $200 million market cap without owning the entire company and moving the stock dramatically on its own buying. This means entire categories of stocks, small caps, micro caps, regional businesses, niche operators, are effectively off-limits for the largest pools of capital in the market. The Wall Street analysts don't cover these companies because the funds they serve can't buy them in size. The research doesn't get written. The stock stays unknown. Lynch's insight. This is where the individual investor has a genuine, structural, non-replicable edge. You can put $10,000 into a $200 million market cap company without moving the stock at all. You can own it before the institutions ever notice it. And when they do notice, when the company grows large enough to attract institutional interest, the buying pressure from those large funds can drive dramatic price appreciation. He called this the moment a 10-bagger is born. How you apply it. Check the institutional ownership percentage of any stock you're considering. Under 20%, potentially interesting. Under 10%, worth serious attention. Zero analyst coverage combined with a strong business and low institutional ownership. That is Lynch's perfect setup. The stock is unknown for reasons that have nothing to do with its quality, only its size. Signal 5 is about insiders, and Lynch had a specific rule about what insider behavior tells you that no financial statement ever can. The signal. Lynch made a clear distinction between insiders holding stock, which could mean many things, and insiders actively buying more with their own money. An executive who holds stock may be doing so because of compensation packages, vesting schedules, or inertia. An executive who goes into the open market and purchases additional shares with their personal capital is making a different statement entirely. They are betting their own money that the stock is undervalued at the current price. Lynch called this one of the most reliable positive signals available to an outside investor, because it's one of the few times you have access to the same information as someone who knows the business from the inside. How Lynch used it. He would look for clusters of insider buying, multiple executives or directors purchasing shares in the same period. One insider buy could be personal financial planning. 3 or 4 in the same quarter at different levels of seniority is a much stronger signal. He was equally attentive to insider selling, but with more nuance. Insiders sell for many reasons. Diversification, taxes, home purchases, school fees. Selling is not inherently negative. Buying, however, is almost always a signal of confidence. There is only one reason to buy more stock in your own company with your own money. You believe it's worth more than the market currently says. How you apply it. SEC filings, specifically Form 4, report all insider transactions within 2 business days. Free databases like Open Insider or SEC Edgar track this data publicly. Screen for companies where multiple insiders have bought open market shares in the last 90 days. Combine that with the other signals we've covered, and you have a remarkably powerful filter. Curiosity gap. Signal 6 is the one Lynch said most investors never want to hear, because it tells you when to sell a 10-bagger. And getting this wrong is how a great investment becomes a disaster. The signal. Lynch was explicit that finding a 10-bagger is only half the work. Knowing when to sell it is the other half, and most investors get this catastrophically wrong. His rule was simple: sell when the story changes. Not when the price drops. Not when the market falls. Not when an analyst downgrades it. Sell when the fundamental reason you bought the stock is no longer true. If you bought a company because it was expanding from 50 stores to 500 stores, sell when the expansion is complete and growth has nowhere left to go. If you bought because of a patent-protected product, sell when the patent expires and competition enters. If the thesis changes, the investment changes. The mistakes Lynch watched investors make. He identified 2 opposite errors. The first, selling too early. An investor buys a stock at $10. It goes to $20. They feel clever and sell, locking in a 100% return. Then it goes to $200. They owned a 20-bagger and got a 2-bagger because they couldn't tolerate the discomfort of watching a winner run. The second, holding too long. The story changes, the competitive moat narrows, growth slows, the industry deteriorates. But the investor holds because they are emotionally attached to the gain on paper. The 10-bagger becomes a 2-bagger in the other direction. Lynch's solution. Write down exactly why you bought the stock. Review it every quarter. If those reasons still hold, hold. If one or more no longer holds, sell, regardless of whether the stock is up or down from your purchase price. How you apply it. For every stock you own right now, write 1 paragraph, the investment thesis. Why you bought it. What would need to be true for the thesis to hold. What events would cause you to sell. Then review that paragraph every quarter. The discipline of maintaining a written thesis removes emotion from the decision at the moment you need it most. When the stock has gone up significantly or down significantly, and every instinct you have is pushing you to act based on price rather than fundamentals. 6 signals. 1 system. built by a man who believed ordinary investors could beat Wall Street, not despite their limitations, but because of them. Let's bring it together. Signal 1. The business sounds boring or worse. Overlooked companies stay underpriced longer. Signal 2. The company does something disagreeable, essential services in unfashionable industries. Signal 3. PG below 1.0. You're getting growth at a price the market hasn't fully recognized. Signal 4. Institutions don't own it, analysts don't cover it. This is where your structural edge lies. Signal 5. Insiders are buying with their own money, the most reliable insider signal available. Signal 6. Sell when the story changes, not when the price changes. Here is what makes Lynch's system different from everything else we've covered in this series. Buffett and Munger require deep financial analysis and years of accumulated expertise to apply correctly. Dalio's all-weather portfolio requires discipline and the right instruments. Lynch's system starts with a shopping cart and a notebook. He genuinely believed, and 13 years of 29% annual returns suggest he was right, that the individual investor paying attention to their own daily life has access to insights about consumer trends, business quality, and product loyalty that no amount of Bloomberg terminal access can replicate. The edge is not information. The edge is observation. And observation is something every investor already has. The next video in this series covers Howard Marks, the founder of Oaktree Capital and arguably the deepest thinker on market cycles and risk of any investor alive. His framework is completely different from Lynch's, and the contrast between the two reveals something important about how different investors can reach extraordinary results through entirely different paths. That video is right here.